Hey there, community bankers. Welcome back to the Correspondent Podcast from Independent Correspondent Bankers Bank. I'm your host, Madison Kaplinger, and we're here today for our Q3 market update. I'm joined by our Chief Lending Officer, Brandon Feltner, our CFO, Chris Dew, and Scott Kimel from our partners at FNBB Capital Markets. How's everybody doing today?
Great, thank you.
Wonderful. Thank you.
Doing great.
Awesome. Well, thank you guys so much for being with us today. I know it's been a pretty eventful quarter, as we've kind of had eventful quarters all year. So I appreciate you guys being here to kind of break some of these things down for our audience. So we'll start out. I'll go to Scott. And we'll talk about how did financial markets perform over the course of Q2 and what were the biggest drivers behind that?
Well, the overriding answer to probably a lot of our issues and questions today can be just summed up in uncertainty. So the uncertainty is the driver in the market right now. We're seeing a lot of cross currents, not only in the fixed income markets, but the equity markets and global markets as well. The overriding sense right now is that there really isn't a whole lot of discernible direction to the markets. But that is driving, in terms of fixed income, short-term rates lower as the market is convinced that whether you or I or anybody else feels like it's necessarily fully justified, the Fed is going to embark on a path downward on the target rate. But at the same time, we're seeing the yield curve twist and longer-term rates are actually going up. It just so happens to be pivoting around the 10-year Treasury, which is a reflection of the disconnect between a potentially slowing U.S. economy, but also the prospect of reigniting longer-term interest rate risk. So that's kind of the theme right now is uncertainty.
Right. And you mentioned the Federal Reserve. As of, the time we're recording this a week or two ago, the FOMC met and the Fed lowered its benchmark interest rate by about 25 basis points, which has, been a long time coming. I feel like a lot of us have been kind of waiting with bated breath for that to happen. And Chairman Powell signaled that further rate cuts were going to be slow coming despite some mounting political pressure on him and on the Fed. So I kind of want to talk through how banks might respond. Should banks start making moves now, or should they wait and see where rates end up at a later date?
Well, the one thing that people tend to forget is that the rates did move a couple of weeks ago. When I say the rates, I mean specifically the overnight rate. But the market had that priced in for quite some time. So when you kind of have this psychological thought about getting ahead of it, you're not going to get ahead of it. The market is already priced in what it believes is going to happen, not only to Fed funds, but to the entire yield curve. That's reflected kind of in a secondary or even tangential way to what you've seen with the price of gold lately. Global gold has gone through the roof, and that is the world's hedge against a devalued U.S. dollar, which is also tied to lowering the short end of the yield curve. So the concept of what should banks do, we always like to say sometimes it's like trying to catch a falling knife. Once it's started, you're not going to catch it. But what you're maybe able to do is start to plan specifically for community banks with your AL models. And this is something that Chris could probably talk to in much more detail. And while banks don't necessarily officially hedge, but that's exactly what they need to start doing now with their AL models, because they're in their positioning, because as this continues, and if it continues, and we don't see a parallel shift of the yield curve down, banks can get themselves in quite a pickle when they are looking at their definition being solely Fed funds and the short end coming down, but longer term rates where they're setting loan rates and home lending and things like that actually going up.
Yeah, I'm glad you kind of pointed to the ALM model and some things to consider there, Scott, because one of the things that I think a lot of banks don't think about that right now is one of those time periods where we need to be getting it back in our minds is that the shifting rates obviously they're going to impact our margins and they're going to impact, the actual like flow of cash. But it's also going to impact the way that our balance sheet gets structured. So, what we've seen for the last several years is we've seen a big shift, a movement of funds from, say, the CD side of our funding over to money markets because we have had more of a flat yield curve. When you have a flat yield curve, people are more willing to take a little bit of return off the table to gain the benefit of liquidity. So if the difference between my money market rate and my 3 or 5 year CD rate is, 25 bips, well, I'll lose the 25 bips and keep the liquidity. There's no issue whatsoever. We're moving into a period now where we're going back to a traditional steepening yield curve. And when we get back to that, then you have the issues of people wanting to move money away from the shorter term, more liquid side and towards more long-term CDs, other sources of funding where they can get a better return. And so I think our banks really need to be aware of the fact when you're working through this in your ALM model, it's not just about doing the what if scenarios of, okay, what if the yield curve stays, ultimately flat on the high end, comes way down on the short end, or what if we do see a more parallel shift happen? It's also what happens to the actual pieces of my balance sheet. What do I see happen on the lending side in regards to people's desire for shorter term loans versus long term? What do I see on the funding side in regards to do I want more, CDs or money markets or savings? And being prepared for that. How am I going to shift? How am I going to respond? And so I know I'm on repeat. I'll probably repeat this again as we talk through other areas, but I've talked a lot in these podcasts about the need to have meaningful analytics as a part of our tools at the banks to know what is truly inside of your deposit portfolio, what's truly inside your loan portfolio, and being able to kind of, I guess, troubleshoot, if you will, some of what's going to happen through this process because it never moves just in a straight trajectory. And so the consumer, the customer, the businesses, everybody will shift their mindset through these changing market rates, and we have to be prepared to respond to that.
And to blend some numbers to what Chris was just talking about, this morning I looked at it and I go back to the beginning of March, which is kind of when all the tariff talk initiated. And so that's really when we entered this current phase of economic uncertainty. This is pretty ironic that it comes out this close, but the 2-year Treasury going back to March 1st this morning was down 33 basis points from where we were on that date. And yet the 30-year Treasury is up 27 basis points. So it's almost a 1-to-1 relationship that for every basis point, the policy sensitive part of the curve has moved down. The inflation fear part of the curve has gone up. And ironically enough, it's all moved right around the 10-year Treasury, which you couldn't do this if you tried. Is 2 basis points different from March 1st to today. So that just underscores the shape of the curve dynamics that Chris was alluding to.
And I want to key in on that for just 1 second when we talk about the shape of the curve, because and Scott was there with me. Scott and I we just spent the last few days at the KBA convention. Of course, you always have economists speak. We were actually very lucky. We actually had a member of the Fed that was there speaking as well. So you get a lot of good perspectives. And on more than one occasion, I heard somebody reference the steepness of our yield curve. And I just remember looking at it, and I actually went back in this morning and looked because I was like, I know I'm not far off. So, they're talking about the steepness of the yield curve, but if you go back historically, so I went back to just 2000. I go back to 2000, I look at the difference between the 2s and the 10s. And from 2000 to 2025 we've had one of the lowest rate cycles. If you take any 25-year history or 25-year period, this has been one of the lowest rate cycles in history. And anytime you have a super low rate cycle, it inherently causes the yield curve to flatten a little bit, because ultimately when stuff starts hitting the floor, it can't go any lower. Even in that 25-year cycle that has been relatively low and therefore a little flatter than historical, the average spread from the 2-year to the 10-year is about 110 basis points. If you look at us today, even if the Fed were to pull rates all the way back to what they consider their neutral rate, which is an overnight rate at 3%, we'd have about 120 basis point spread between the overnight, so not even the true 2-year, the overnight rate and the 10-year rate. That is not a scary or inherently overtly steep yield curve, but people are talking about it like it is because they've not been accustomed to it. It has been so long since they've seen it and experienced it, and they think it's something bad. The reality is that this is the yield curve where banks historically have performed at their peak, but they haven't had to do it in so long. I don't know that, shifting back to it's going to be complicated. That's true. But banks always made money borrowing short and lending long because there was inherent spread in the yield curve itself. So I just found that interesting. And so as soon as Scott said yield curve, I thought I have to throw this in here because, again, that conversation around how steep it's going to be or how steep it's becoming, it's nowhere near, where it has been historically. And really, it's even if it shifted to all the way down to Fed neutral rate, it would be right in line with what our 25-year history has been. So now, Scott may have a slightly different perspective than I do on that, but as I was looking at it, that's what I saw.
I'm actually, as we're talking here, I just logged into the Bloomberg and I'm trying to find exactly when I was going to look at the 2-year to the 30-year and just see, kind of all the way out the curve.
Right.
But we are, to Chris's point, we are nowhere near, what traditionally has been a steep yield curve. It's almost like people that, young people today, they say 7% mortgage for their house and they go into shock. We'll talk to any of our parents,
Yeah.
They would have died for. So it's everything in life, not just economics, is relative.
Yes, very much so.
Very true. And I always, love hearing perspectives from bankers who have been in this a long time to kind of get context for, where we are now versus, what things may have looked like before, 25, 30 years ago. And we've kind of talked about the rate shifts from a capital markets perspective, from an ALM perspective. So I'm going to go to Brandon now. What does this move mean for loan demand? I mean, Scott kind of alluded to the markets having moved a little bit before the Fed. Do you see this having kind of an outsized effect on loan demand, or do you think things will keep moving the same way they have been?
I think things will continue to move the same way they have. Margins will adjust a little bit for, the prime and the 5-year treasury, which are the two most common indexes that we see pricing in commercial loans. And, I think the margins will just adjust with the rates, but I think overall demand and volume will stay the same throughout the year. And as rates continue to lower, we may see it pick up at the beginning of 2026.
Right. That makes sense. And speaking of the Fed, there's been a little bit of tension between the White House and the Fed in a way we haven't really seen in the past. President Trump moved to fire Fed Governor Lisa Cook, alleging mortgage fraud, although no criminal charges have been brought as of yet. We have lower courts ruled that Cook can remain in her post, but we have the president now appealing to the Supreme Court. Does this mean anything, anybody, does this mean anything for the independent nature of the Fed? And do you see markets responding to this in some way, or are they already?
Yes, to all those questions. Yeah, regardless of what side of the political spectrum you find yourself, you've got Jamie Dimon and all of the large institutional folks, as well as a lot of the G7 nations have all weighed in on the fear that I heard a great line that the Fed's dual mandate will now become a tri-mandate, that you have to, maximum employment, price stability, and pleasing the administration. And that does have, I think by a general consensus outside of the West Wing, a pretty chilling effect on the markets.
Yeah, I think the risk associated with it, I think most people don't fully appreciate how risky it is. Should we reach that point to where we do lose some of that Fed independence, and the market is very aware of it. The market recognizes it. Even the people who may want to see some of it happen, they also understand the risk associated with it, and not even just the risk that exists within the current cycle. I think the thing that probably scares me the most about it is the long-term risk that comes along with setting that as a precedent, to where now you've built that into the system to where you do have an administrative branch that ultimately has that level of control. And in the future, we have no idea how that may be used to dictate the outcomes. So yeah, the risk is very, very real. And I do fear if it were successful, how the market would ultimately react to it.
This is the spread between the 2-year and the 30-year. And right now it's 48 basis points. Chris, to your point, on February 2nd, 11, it was 401 basis points, but you can see we are at a very, very low, other than the Great Recession back here in 2008. We are very, very flat still.
Well, yeah, I mean, it's right. Your median is 224 bips, and we're setting it.
I went back to 2000.
Yeah. So like I said, in this the same period I did, this 25 years, because I don't necessarily believe we'll see we could. The market has done stranger things. I don't necessarily think we'll see a reversion back to the market that we had in the 80s or maybe even the 90s. But 25 years is not that long for an economic cycle to be observed. So in my opinion, the fact that historically we were at that 224 basis points and today we're at 50, and we're talking about the risks of this steepening yield curve, it's not steep. Honestly, we need it to steepen in order for things to normalize, in my opinion.
Yeah, that goes back. I just changed it back to 2080, during the crazy times.
Yeah.
So anyway, yeah, that just, when you said that, I thought, okay, this is a great way to look at it. And if we look at just, what did we say? That was February 02, 11. What was the date? 2000?
2000, I believe. Yes.
Yeah. Well, anyway, you get the point.
Mm-hmm.
Right. And I think you said in an earlier, maybe the Q2 podcast, Scott, that as much as the market hates bad news, it hates uncertainty more. And all of the Fed news I hear, coming out challenging its independence, that's kind of what went through my head. It's like, is this uncertainty or is this bad news? Because either way, not great.
And you can edit this. I don't know if we talked about this last time. I don't think we did, but in the last Fed's beige book, which is, quote unquote forward guidance for not just community banks, but the global markets, the Fed used the word uncertainty 80 times. The previous record prior to that was 45. They didn't even use it that 45 times during the Great Recession or COVID. So again, if you just look at what the Fed is saying now, and the markets obviously parse the Fed's words probably even too much, but for them to purposefully use the word and insert the word uncertain or uncertainty 80 times in their latest beige book, that's telling.
Yes. Right. Absolutely. So I'm going to kind of.
I equate it to going to the store and getting a card for my wife and opening it up, and what's one of those blank cards where even Hallmark now is going, we don't know what to tell her. We don't know what you did wrong. And that's kind of what I think the Fed is saying to us now is, hey, we don't know what to tell you.
Right.
So as Scott mentioned too, I think, the uncertainty, I think that's what has got a lot of business owners just really holding off on moving forward with expanding their business or starting to venture into a new business. Is just that uncertainty to see, how the economy, stabilizes and rebounds this year, perhaps teeing it up for bigger things next year.
Well, that same uncertainty, a lot of the conversations I've had just in the past week with the bankers, they're carrying that weight as well. So, when I ask them, hey, well, how's your deal flow coming? What's the pipeline look like? And there's a lot of conversation around, like Brandon just mentioned, well, some of our businesses are trying to decide if they're ready to act or if they're not, because they're a little concerned about putting too much capital to work right now if things were to pull back. But then the bankers will even tell you, I'm a little nervous about whether or not we want to extend that risk at the moment, because we're not certain how things are going to go. So it's being felt throughout the entire system. And, you kind of get that push-pull effect where, everybody wants to believe that it's going to continue going the way that it is, but they also see all the signs that it could pull back. They want to continue to grow, but they don't want to get in a risky situation they can't recover from. So I would say there's a greater deal of tension today than there has been. I've been in banking now for 19 years, and I actually had this conversation a couple of days ago too. That as a survival of the financial crisis, a survivor of the financial crisis. I remember what that process was like, but it unfolded so fast that we didn't have this period that we have now, where we're kind of constantly questioning what's happening and what's going to happen and how is it going to impact broadly. And so I think it's heightened some of that concern.
So that's a pretty good segue from, the Fed and the macro level down to community banks and the micro level. I know the uncertainty is kind of hitting them as well. And we mentioned, loan demand, but what kind of challenges are they facing in terms of their loan performance right now? Are they seeing those effects in their current deals, or is it more affecting just their pipeline?
Yeah, I think a little bit of both. I think, banks are continuing to stress test, and, given where we are with interest rates, it is really shocking the credits, but it's just prudent due diligence and continue to monitor credits, monitor the relationship, checking accounts, and just, really just keeping a full, approach on the overall business relationship, seeing how it's performing. So, yeah.
I think there have been signs. We have started to see an uptick, especially in automotive and credit card past dues. That's kind of started to climb a little bit. There's been I guess I'd say the high level numbers are not concerning or alerting necessarily. It's been more the movement in the trend, and there's been some larger stories come out about it, but they can kind of be passed off as being one-off. But the trends are generally moving in that direction, that it's showing signs of more credit risk there. Thus far, it has been more heavily isolated to consumer. But quite often, a lot of issues. We're a consumer-driven society and a consumer-driven economy, so usually that's where the cracks start to form. So I do think it's starting to show more of a trend in that direction, but it's not overwhelming as of yet.
Right. And I've seen a lot of stories about, consumers pulling back spending, which is, obviously going to have an effect on our banks. But we talked about the loan side, but what kind of challenges are they facing in terms of liquidity and, deposits and those sorts of things? I know in uncertain times, banks like to have a little bit more liquidity on hand. Is that something we're seeing as well?
We're seeing them, they've been kind of in a liquidity building mode for a while, but it gets a little bit cyclical because, their their need for liquidity versus the needs of, say, their customer bases sometimes don't fully align. And so there is kind of this constant shift going on, but there has been a pull towards higher liquidity levels. But then we've also seen a redeployment. We've seen quite a few that have so Brandon can, he spoke about kind of our loan pipeline. Part of the reason we've seen a little bit of a decline in that was there has been a little excess liquidity in the system. They've been able to redeploy that and fund their own loans without having as much assistance from us. So they kind of continue to build it, but then they'll use a little bit of it. But they are building liquidity. That's typical. As far as the deposit side, what I've seen in my conversations is it seems to be a real mixed bag. A lot of the folks that if you have high net worth individuals or larger businesses as a part of your deposit portfolio, most of them are continuing to see higher levels of liquidity within their customer bases than they have traditionally. The ones that are a little bit more dependent on small businesses and kind of the lower average balance, if you will, consumer, they have definitely seen that kind of continue to trickle out. They have not, said that it's a mass export, if you will, of cash, but the trend has been downward. And so, there is a lot going on with banks trying to do what they can to bring in more deposit growth, which that's a never-ending cycle with banking. We're always trying to find ways to grow more deposits, more relationships. But I'm starting to hear more folks that are sharing some concerns over that kind of trickle out effect for the ones that are heavily consumer reliant.
And on the capital market side, I know we've talked about this in the past, but after 2023 and 2024, where rates shot up and securities portfolios were all underwater, there has been a much more concerted effort to maintain probably more liquidity than prior to COVID, let's just say. There's been a psychological reset, one that I don't have any problem with and actually fully understand, both from a comfort level and also, I think, driven a little bit by the examiners, where a bank, used to maybe say, okay, I'm comfortable keeping, $5 million in cash and Fed funds. That bank now may say, well, I'm a little bit more comfortable with 9 million or 10 million. So we've seen a psychological reset, one that again is fully rational and almost to be expected, coming out of such a shock that we did over the past 5 years.
Mm-hmm.
Right, for sure. And we've talked quite a bit about uncertainty in the market over the course of this podcast, both on kind of a macro and a micro level. I feel a lot like the beige book right now that you mentioned. Scott, I certainly hope nobody's playing any kind of drinking game about how many times we say uncertainty in this podcast. They might be dead. But so it feels odd to ask if there are opportunities inherent in a market like this that banks can position themselves to take advantage of in the coming quarters. But, do we see any ways that, banks can kind of position themselves to take advantage of opportunities coming up?
I'm going to sing kind of the same hymnal as last quarter and probably the quarter before that. I think right now banks probably should focus on the capital market side on watching cash flows and maintaining consistent cash flows, not taking any bets. Don't be lured in by complexity for something that really isn't that difficult right now. Just keep it close to the vest. If the Fed has no idea what's going on, not that they really ever do, to be honest, because nobody can predict the future. But even at this point where they really have no consensus guidance, with all due respect, the four of us probably aren't going to lend anything to that other than an admonition to stay safe.
Yeah, I would probably echo a very similar thought. right now is a time, and I'm going to actually say something that I've said, I think every time I've done one of these podcasts. Right now is one of those times where I really and truly promote spending time to better understand your balance sheet and how it's structured, and to better as much as you can understand, what some likely shifts are. While Scott is 100% correct, we cannot predict the future. We can look a little bit and say, okay, well, what seems to be the most likely scenario, at least in the short term? And as I think we've all generally agree, the most likely scenario in the short term is that we see a continuation of where we are, meaning the longer end of the yield curve is likely to stay relatively stable with maybe more upward pressure than downward. And the short end of the curve is anticipated to drop and go down. And being aware of that and aware of how it's going to potentially impact your balance sheet, as I said earlier, what does that mean in regards to possible shifts from shorter term deposits to longer term deposits? What does it mean in regards to a shift on the loan side? Are we going to see some of these, commercial real estate deals roll the dice, and instead of wanting to lock in the 3 and 5 year time frame on a deal that is maybe completed construction, they're going to want to hold it for 3 to 5 years as a variable rate and try to ride the wave down? There's not a lot that we can do as bankers to stop those things from happening. What we can do on the front end is understand the risk associated with it and how willing how far we're willing to take it, and how long we're willing to be involved in it and contribute to it. So I think being prepared on the front end and understanding that, I still think, this is the time, if I haven't already done it, I want to be, whether it's buying or building internally, whatever it is, or finding a third party to help me, I want to be doing some analytics on my overall positions. I want to understand, what does my loan portfolio look like? I'm going to be a little biased here and say, the stuff that's in the consumer realm, if I only have a certain amount of time to dedicate, I'm probably going to dive into those faster. If I have auto loans, especially if I have any kind of revolving credit cards, HELOCs, I want to be looking at those, and I want to understand, what's my risk profile look like? What have my trends been? I think that's one of the things that most people can tell you where they are today, but can you tell me your HELOC utilization rate today compared to what it was 6 months ago, 12 months ago, 18 months ago, 60 months ago? What has been the long-term trend? Because a lot of times the risk won't necessarily show itself in the levels, but the risk will identify itself in the trends. I would be doing the same thing on my deposit side, and do a little bit of, a little breakdown on it to understand, it's not just about the total dollars. It's how have the dollars shifted. It's, what's my personal deposit relationships look like compared to my business deposit relationships? What have the trends been? And where are they compared to 4, 5, 6 years ago? Because again, if we go back to 2021, I was doing a lot of this in my bank at the time, and we could tell that our average commercial balances and our deposits were 200 to 250% higher on a per average basis. This was not dollars. This was just average balances, 200 to 250% higher than they had been the previous 24, 48 months. That matters, because that tells me that I don't think all of my businesses are doing that much better over that 2 to 4 year period. There's an excess of cash in the system and they're holding it. And so I think doing analytics along those lines to understand where you're really positioned, where your risk might be, and to do your best to prepare for it. It's not necessarily that's not the fun, beautiful part of banking, I'm not going to lie, but it is the part that will help you build the best bank you can and manage the risks when they do show up.
Now for the invocation. It's
Yeah, well said. And I think that is a great place to kind of end today's conversation. Scott, Chris, Brandon, thank you all so much for coming on here and sharing your perspective. Hopefully our community banks get something out of the advice given today. Though we can't predict the future, it's never a bad time to be cautious and to dive into your balance sheet.
And I'll leave you with my favorite quote that I think is kind of overarching, and it was, I may have said it last time, but I think it bears repeating, by Benjamin Graham, that the reason we have a margin of safety is to render the forecast unnecessary. I think that's a great point for community banks right now.
Yes, I like that one.
Amen.
Yeah.
Thank you for listening to the Correspondent Podcast. We hope that you've learned something valuable to take back to your community bank. If you're listening on Spotify, leave us a rating and review. If you're watching on YouTube, please subscribe to our channel for more updates. See you next time, community bankers.